A credit score of 512 costs you about $2,400 a year, not in debt, not in late fees, in price. The extra you get charged for the exact same things everybody else is buying. The same apartment, the same truck, the same insurance policy. Because of 3 digits almost nobody explains to you. Here's what that actually looks like, category by category, with real numbers. Quick correction first, because most people have this wrong. Your credit score isn't a measure of whether you're good with money. It's a prediction of whether a lender gets paid back. The formula breaks down to roughly 35% payment history and 30% how much of your available credit you're using. Those two alone are over half the score, with the rest split between how long you've had credit, how much is new, and the mix of account types. It doesn't know your income. It's never known your income. It doesn't care if you haven't missed a payment on anything in 2 years, if the number underneath still reads low. That distinction is the whole video, so hold on to it. Start with getting a place to live. A landlord runs your credit, and most treat somewhere around 620 to 650 as the floor. Under that line, you're not denied. You're moved into a different category where the answer is still yes. The price is just higher. On a $900 a month apartment, that shows up as first month, last month, and a security deposit equal to another full month. $2,700 up front instead of $900. Roughly half of states cap what a landlord can take as a deposit, usually at 1 or 2 months' rent, which is the only reason it's $2,700 and not more. The utility company does the same thing. A deposit, in this case $180, held for a year, refunded only if you don't miss a payment. This is where the number gets expensive in a way you actually feel every month. Lenders sort every applicant into tiers, and the tier prices the loan before a human ever looks at the file. Someone at 781 or above is averaging around 4.66% on a new car loan right now. In the 500 to 600 range, it's about 13%. Same car, same job, same payment history going forward, just a different price tag on the interest. Run the numbers on a $22,000 loan over 60 months, and the gap between those two rates is just under $89 a month. $1,066 a year for the identical vehicle in the identical parking spot. It gets worse the bigger the loan. On a $26,400 truck with $4,000 down, financed over 72 months. At 512, the rate comes back around 15.9%, $485 a month. At 750, 6.4%, $375 a month. $109 a month difference. Just under $7,900 over the life of the loan. Same truck, same lot, same afternoon. And the part that actually gets people. The whole transaction takes about 10 minutes, and nobody in the room is being unfair to you. Everybody's following a rule that was written a long time ago by people who never met you. It's completely legal. Auto insurers use the score too, in most states, and they'll tell you flatly it's because the number predicts claims, statistically, at scale. Not because your driving is any different. Full coverage, same clean license, same roads, $2,602 a year at a low score. About $1,853 at excellent credit. $749 of difference for identical risk on paper. Here's where people who don't know better make it worse without meaning to. Store financing, the card for the home improvement chain, the tire shop, the furniture store's 0% promotional deal, looks free. It usually isn't. On most of those deals, the interest isn't waived. It's deferred. If there's a single dollar left on the balance when the promotional period ends, the interest can retroactively apply to the entire original balance, not just what's left. Someone with 3 of these cards open, combined limits, around $4,400, already carrying $3,100 of it. That's over 70% utilization, which is the second biggest input into the score after payment history. Every one of those cards is quietly working against the number, not for it. It's not just landlords, lenders, and insurance companies. The number follows you into places that don't feel financial at all. Try to open a postpaid phone plan, the kind with a real carrier, not a prepaid card from the drugstore. And most major carriers run a credit check before they'll hand you a contract. In the $500 to $600 range, expect a deposit somewhere around $200 to $400 just to get the line turned on. Below about $550, some carriers will turn you away from a contract entirely and route you straight to prepaid. And in most states, a potential employer can pull a version of your credit report as part of a background check with your written consent before making a hiring decision. It's not a factor everywhere. A handful of states have started restricting it. But where it's allowed, the same 3 digits that priced your apartment can quietly sit in a hiring folder too. It's rarely one bad decision. It's usually one real emergency that nobody had a plan for. Take a fairly common version of it. An appendix. During a 6-week gap between health coverage, one job ended, the next hadn't started yet. $14,200. $400 in savings at the time. The bill goes unopened for months because opening it doesn't make it smaller, and it's easier to put it in a drawer. It goes to collections around month 8. The credit card that absorbs the overflow tips past 90% utilization. Then, whatever vehicle was financed at the time gets repossessed. 3 separate events, 1 root cause, and a score that was 681 2 years earlier is now 493. Here's the uncomfortable part. Some of that is a choice, not just bad luck. Most hospitals have a charity care program that would have covered most of a bill like that if you call and ask in month 1 instead of month 8. That phone call is the single highest leverage 5 minutes most people in this situation never take. Shorter list than the internet wants it to be. Paying off a collection is worth somewhere around 20 to 50 points, and the 2 newest scoring models ignore paid collections entirely. It takes 30 to 45 days to show up. Getting your card utilization under 30% moves the number faster than almost anything else, often within a single billing cycle. A secured card, used lightly and paid in full every month, takes 12 to 18 months to do real work at the lower end of the scale. One more lever people skip because it feels like a favor, not a strategy. Becoming an authorized user on a family member's older, well-managed card. It's added about 22 points on average in studies that have tracked it, sometimes inside a single billing cycle, because their account history, the age, the limit, the untouched-looking utilization, gets folded straight into your file. The catch, it goes both ways. If that account carries a missed payment or runs hot on utilization, some of that reports onto you too. It only helps if the card you're riding on is actually being handled well. And a collection loses most of its weight after 2 to 3 years of clean payment history after it. The clock is running even on the months you're not thinking about it. A reasonable estimate, based on those levers alone. Someone starting at 512 who pays down a collection and keeps utilization low could realistically be in the high 500s within about a year and approaching the mid 600s within 2. 700 is more of a 4-year number, and 4 years is going to pass regardless of what you do with them. It compounds outward too. On a $300,000 mortgage, moving from a 620 to a 760 is worth roughly $156 a month. About $56,000 in interest saved over 30 years. That's the number a low score is quietly taxing you on before you've even started looking at houses. 14.9% of Americans are under 580. That's not a fringe case. That's roughly 1 in 7 people. The national average sits around 714, which means the distance between below average and ordinary is usually just a few years of nothing dramatic happening. Nobody announces it when you cross. $2,400 a year isn't a catastrophe. That's what makes it dangerous. It's small enough to never become the emergency that makes you actually do something about it. So, have you actually looked at your number this month? Or are you doing the drawer thing?